Right. In this session, we're going to take a few more accounting standards. Basically, we are highlighting the key areas of the relevant standards from a theoretical perspective for you to do your case studies based on these standards. So what are the standards we are going to take today? We're going to discuss LKS 16. Then we are going to discuss LKS 38. LKS 16 is property, plant and equipment. LKS 38 is intangible assets. LKS 40, that is investment property. So all sort of assets related standards. And of course, because we are discussing these three standards, we can't forget SLFRS 5, non-current assets held for sales and discontinued operations. Of course, when you have intangible assets, investment properties, LKS 16, there's another connected standard, that is LKS 36, impairment of assets. So those are the standards that we are going to do a kind of an overview in this session, right? So let me start with LKS 16. So our lineup for LKS 16 is basically, let me first take the lineup, then it's easy for us to discuss. Right. So firstly, recognition. Secondly, initial measurement. Then of course, subsequent measurement, or the subsequent, let's first discuss subsequent cost and then come to subsequent measurement. Initial measurement, subsequent cost, then subsequent measurement, then depreciation, then derecognition, right? Right. So this is our lineup for this topic. So let's take a look at one by one. When it's come to property, plant and equipment, normally property, plant and equipment means assets you are expecting to keep for more than 1 year. And of course, you're keeping that assets for you to get support to support your day-to-day operations, or for administration purpose, or production of goods and services, or any other connected services, right? So one is it should facilitate production of goods or services, or your administration purpose, or any other business related activities, your core business, and you're expecting to use those assets more than 1 year. So that is the kind of definition of PP. Why I highlight the definition first. When you have been given a scenario, first ask whether this particular asset fulfill the definition, and then come to the recognition criterias. So there are two recognition criterias. Okay, there are two recognition criterias. First recognition criteria should be, this should be, it is probable that future economic benefits will be derived. So probable future economic benefit. benefits, and cost can be measured reliably. So those two criteria need to be satisfied for you to recognize an item as a PP&E. If there's any item for you to recognize as part of PP&E, first there must be probable future economic benefit derived through that item, and the cost can be measured reliably. So this could be an estimate, not necessarily an exact amount. This could be an estimate. And here, what is meant by probable is more than, normally more than 50% probability, more than 50% chance. So where I got this probable more than 50%, you remember LKS 37, it discusses about probable cash outflow. When you explain the criteria for provision, they are probable defined as more than 50%. So same will impliedly apply here, right? So that is recognition. So when you have been given a scenario, ask the question whether these two recognition criteria satisfy, whether definition satisfy, then it's under PPA, right? Initial measurement. When you do initial measurement, it should be at cost, right? Your initial measurement should be at cost. However, not everything and anything. When you say cost, you can take three types of cost. That one is, of course, the purchase cost. So any other directly attributable cost, and dismantling, we call as decommissioning, also restoration, right? Purchase costs, that is very clear. The amount you should pay to your supplier and any other suppliers who have provided you certain services to bring that asset to your location. So those are purchase related cost. Directly attributable cost mean any other cost that you have incurred which will support or which will help you to bring that asset for that intended use, that can be taken as part of the cost. Remember, you need to ask these two questions also. So let's say you have been given a set of cost items related to a PP&E, and then let's say you will be asked, okay, identify what's the total cost. Purchase cost is straightforward, but when you say directly attributable cost, ask the question whether these two will be satisfied. More importantly, whether there's a future economic benefits through this thing, then you can recognize, right? Third one, it's a very rare or very specific case, the dismantling or decommissioning or restoration cost. This will not apply for every PP&E item, but there are certain PP&E items. Say for example, let's say it's a telecommunication tower. In telecommunication business, you have seen telecommunication towers here and there. So telecommunication towers considered as part of PP&E. So for these telecommunication towers, yes, you will have purchase cost. You will have directly attributable other cost. And there's another component also come to this particular asset, that is dismantling. What is dismantling here is, now let's say this telecommunication tower, you have established that telecommunication tower or installed that telecommunication tower in someone else's property. And the understanding is that this property you have rented out for, let's say, maybe 5 years or maybe 10 years because of your need. Like you decide, okay, this telecommunication tower should be there for X number of years. For that, you have rented out. But in that rent agreement, there is a condition to say that, okay, look here, you can occupy this land and we will charge you some rent. That's different thing. But when you remove your telecommunication tower, you need to make sure you will give us the land at its original condition. Meaning now when you do installing telecommunication tower, you have to do certain things for that land to make it properly arranged for the establishment of the tower. And when you take it out, then you have to do certain things. But the understanding is that you need to basically properly hand over the land to the owner once you have utilized. So for that plus for the removing the tower, you definitely incur some significant cost. Maybe not today, definitely not today, but maybe after 5 years, after 10 years. So that should also be a part of your PP&E. That is what we call dismantling cost, so that you do a present value calculation and estimation of future whatever expenses that you have to incur. That present value, you can take it there. That's a different calculation, but that's also part of your PP&E cost. So that is initial recognition at cost. Now, for PP&E, yes, you purchase today, you record initially as PP&E, but subsequently also you incurred some cost, right? Let's say, for example, I have a machine, and after 1 year, someone comes and technician comes and check this machine and do some repairs. Or after 2 years, okay, you need to replace part of the component in the machine to make it usable, and you do a replacement and new component coming in. Now, these two are subsequent costs. But the question is how I should deal with these two scenarios. Should I take everything as part of PP&E and adapt to the carrying value of the PP&E, because those are subsequent costs for the particular underlying asset, in this case machine. What standard says, you can't take everything and anything as subsequent cost to the PP&E. You should always ask the question whether these subsequent costs also generate future economic benefits and whether costs can be measured reliably. If two recognition criteria are met, only those subsequent costs can be capitalized. So subsequent cost, ask the question for subsequent cost, ask the question, recognition criteria satisfy, yes, then capitalize. Recognition criteria satisfy, no, then expense. Right? So that is basically what you should do when it's come to subsequent cost. But what about major repairs? Let's say I am a shipping company. I have some ships, and after 3 years, there is a industry practice in a regular interval. There must be some major repairs taken place in the ship. Let's say after 3 years, maybe after 5 years. It's a big amount that you spend, but it's like a repair. So, normally repairs and maintenance mean subsequent costs that you have incurred for PP&E, but it will not necessarily enhance the future economic benefits, improve the future economic benefits of the underlying asset. Because of that, normally repairs and maintenance you charge to P&L as an expense. But in this case, why this major repair coming in after 3-4 years? To maintain, to make sure this ship will perform as with the original state to generate future benefits. Why these major repairs happen after regular intervals? To make sure the ship's conditions will be enhanced or will be re-established, restate, to make sure that it will function as the original capacity, original way. So meaning, even though this is a repair after 3-4 years, the purpose of doing this major repair is to make sure that you will have no disruption in generating economic benefits. In that case, because these expenses will support you to generate economic benefits, that can be capitalized. Okay, major repairs, capitalize. Right. So we have discussed up to this point, right? So let me take some space for us to go through the balance part. So it is important for you to understand two recognition criteria and also to identify the elements of the cost when you do initial recognition, And when it's come to subsequent cost, ask the question whether these subsequent cost will meet the recognition criteria, to recognition criteria. If yes, you can capitalize. If no, you can't capitalize. But when it's come to a situation like major repairs, you can still capitalize, because major repairs help you improve the cash flows, right? Subsequent measurement. So, initially we recognize that cost. So, when it's come to subsequent measurement, you don't necessarily need to continue cost. So, there are two policy choice, right? One, you can continue recording at cost less accumulated depreciation less impairment, right? Or you can move into revaluation model. Subsequently, you can move into revaluation, and then on revaluation amount, you can identify accumulated depreciation and impairment, right? Right, and impairment. So, subsequent measurement, you have two methods you can follow, either cost model or the revaluation model. Cost model basically continue the way you were doing. So, when you follow cost model, your carrying value should be cost minus accumulated depreciation minus impairment, if any. And if you follow revaluation, on revaluation amount, revalued amount, do the accumulated depreciation, do the impairment, and that is your carrying value. Now, here, what is important is to understand this part, right? So, revaluation, yes, standards say that you have a policy choice for revaluation, but always remember, when you apply revaluation model from cost model to revaluation model, ask yourself whether this policy change makes sense for my entity. Not just because it is there in the standard, not just because revaluation model increase the values of assets. You should not use it. You should ask the question whether it makes sense to apply revaluation model for my entity, and then only you go for revaluation model. So, first model to revaluation model is a changes in accounting policies, but as we know, under 𝐂𝐜𝐴𝐻 it says revaluation cost model to revaluation is a changes in accounting policies, but you don't necessarily need to follow retrospective method because it's not practical. Whereas things like revaluation, you can't go back to the past and do it. It's always future. So because of that, change from cost model to revaluation model is a change in accounting policy, but you have an exemption to go prospective. So that is anyway policy change impact. So revaluation. So if you do revaluation, what will happen? Your asset balance will increase, carrying amount will increase. So asset will be debit to that amount, and you will have a revaluation surplus coming to your account. That revaluation surplus will be a part of your reserves in your statement of financial position that come through other comprehensive income. So now you have done your first revaluation. There is a revaluation surplus. Let's say revaluation surplus is 1,000. Subsequent to this revaluation, after some years, right, you have done your second revaluation. As a result of that revaluation, you got another surplus coming in. Of course, there are also double entry won't change, PP debit, revaluation reserve credit, and you will have a plus something coming in here, and revaluation reserve will be, let's say here 100, 1100, right? But what if when you do your second or third revaluation, subsequent revaluation, you noted there is a reduction in value, and the new value resulted having a revaluation deficit of, let's say, 800. So this is first revaluation, this is second. So because of subsequent second revaluation, let's say now you got 800 deficit. So ideally, deficit means the reversal of this entry, revaluation reserve debit, PP credit. What standard says, yes, you can do that entry, provided you have sufficient surplus already in the accounts. So in this case, deficit is 800, you got 1000 available, yes, then you can set off because if the surplus is higher than the deficit. So then remaining 200 will go as revaluation surplus. What if this is not 1000 but this is 500? Now if you do the reversal, revaluation reserve will be negative 300. That is not make sense, right? So what standard says, when you have a situation that you don't have sufficient revaluation surplus available to set off against revaluation deficit, what you do is first you eliminate revaluation surplus in full. So in that case 500 negative and balance 300 loss revaluation deficit, you direct to the P&L as impairment loss, right? This will go to OCI, this 500 will go to OCI, the reduction, but balance 300 will go to P&L as impairment loss. So normally we know that revaluation surplus will go to the reserve in the financial position through OCI. But in this scenario, revaluation adjustment will go to OCI plus P&L because of this surplus deficit mismatch. I believe you understand that. And when it comes to frequency, now you have done the first revaluation today, and when would be the next? Standard say normally, if there's no significant changes in the market that warrant change in your values of assets, you can wait up to some 5 years to do the next revaluation of PP&E. When it's come to property, plant and equipment, if you follow revaluation model, you can have a 5-year break for the next revaluation. However, if there are events that will give you some warning, so that will give you some comfort, look here, you don't need to wait for 5 years, you can revalue, or you should not wait for 5 years because the value has gone down. Why not you do revaluation for that particular class of asset? Then you should do it, because and if you wait for 5 years, that will be too late, especially when the value go down, right? So I believe that's clear. So the next is depreciation, right? So the next is depreciation. So depreciation is, we know that systematic uh, reversal kind of systematic release of the cost of the asset or the revalued amount of the asset. So when it's come to depreciation, it is very much important for you to decide what is my useful life, right? So ideally depreciation mean you have the cost of the asset minus residual value and divide useful life. That is your depreciation. So residual value means the amount that you expect to realize from that asset after the expiration of useful life. That is a residual value. So you can't depreciate that because you're expecting to recover. So sorry. So normally residual value concept is there, but practically application is very rare in most of the cases. But ideally when it's come to depreciation, it's cost minus residual value divide useful life. So useful life is an estimate, accounting estimate. Basically today, let's say today you brought an asset and you capitalize. Today management decide this is the useful life of this asset. Basically when they are deciding the useful life of the asset, they take the support of the technicians, technical expert, maybe the manufacturer's recommendations. So today you establish the useful life. As per the accounting standard, even though you today establish useful life, let's say 5 years, you can't take it as a guarantee for rest of the 5 years. But standards say because this is an estimate, every year you should revisit the useful life of the asset and ask yourself whether this 5 years still appropriate. If not appropriate, either increase or decrease. That should be an annual exercise, right? So that is what you need to know about depreciation. And the one last is derecognition. So you de-recognize PPNE item either because of disposal or maybe impairment or write-off. So it could be disposal or impairment. Impairment or we call write-off, right? So impairment of write-off we are going to discuss in this session later on. So disposal is basically you are disposing part or full class of your asset to someone else. So then it's a de-recognition you have to take out from your books of accounts, right? Impairment is basically value go down, the recoverable amount go down compared to the cost. Then you have to build up. We have to identify a loss, that is impairment loss. That value go down maybe zero or value go down maybe some amount below the carrying amount, and the difference is your impairment loss. So that is basically LKS 16. Now let's move into the next standard is LKS 38, right? LKS 38. So LKS 38 we're going to discuss now. Right. So LKS 38, let me have the lineup for our easy purpose. The definition, very important. Then recognition criteria. Then R&D, research and development cost, very important phase. Then measurement. Then the amortization and impairment. Right. Okay, definitions. Intangible assets, not like PPNE. PPNE are tangible assets. By nature, intangible assets you can't see, but should be able to identify, right? Identifiable should be able to identify. No physical substance. So you don't have a physical substance, but identifiable, and of course, it's a non-monetary asset, right? So if you have a identifiable as non-monetary asset which does not have a physical substance, that is an intangible asset, right? That is basically the definition of intangible assets. Recognition criteria, like PPNE, same thing apply. Probable economic benefits, future economic benefits, and cost can be measured reliably, right? Of course, you should have the control over the asset and whatnot, but most importantly, two recognition criteria, cost can be measured reliably and future economic benefits should be probable, right? So if that's the case, you can recognize intangible assets. More importantly, right, these two, it's very kind of straightforward, but more importantly, this thing is a special area when it's come to this particular standard, research and development cost. So standards say, now what is research and development cost? Let's say now you are a drug manufacturing company where you do your research and development and come up with new drugs. So when you do your research and development, what you first do is you got the idea, okay, we want to go for a new drugs for this particular disease, so this particular case. So what you do is you do some surveys, you do some reading, you do some background studies, you do some research, and you do some information gathering for that particular purpose. You have not started anything on the commercial production point of view, or the testing point of view, or the manufacturing point of view, or the development point of view. You have done not done anything, but you're doing kind of a background study that we can call as research. Just because you have done this background activities, you won't have any asset coming into you and no economic benefits coming in. So research is just a activity with no return. So because of that, if you have any expenses connected to research, any cost you incurred connected to research, you should expense it. Development cost. Development cost you can capitalize. You can capitalize as an intangible asset, and you can amortize and impairment and everything comes in, provided you fulfill certain criteria. So development space, when it comes to development space, meaning now you are doing the manufacturing of the drugs. Now you have done your research and you're happy, okay, we want to go with ABC drug. Now you start things. So now it's a developing activity. But the question is, just because we started development, can we create an asset? Basically intangible asset. Yes, standards say yes, you can create an intangible asset provided you fulfill certain criteria. Not one of the criteria, but all the criteria. So there are 8 criteria. Okay. So 8 criteria. For your easy purpose, I learn and I'm sharing with you. I like to use this word. So then you can easily remember. What's the word? Pirate. You know pirate, right? So pirate 1, 2, 3, 4, 5, 6. Okay, 7 criteria actually, right? Okay, 7 criteria. So pirate. P is for probable. So probable economic benefits. So you should be able to establish that there's a probable economic future economic benefits, right? Then intention to product and sell. Not just product and sell. Now you start your development, but there must be an intention to complete the production and sell it. Otherwise, no point, no, right? So that should be their intention to complete rather product. Let's say intention to complete, right? So pirate is the word. Probable future economic benefits. Intention to complete and sell. Then you have intention to complete and sell. You should be able to sell also. That is called ability to sell. Then availability of resources and here availability of resources. So you must have resources, right? Availability of resources, and yes, R is for now probable future economic benefits recognition criteria. R is reliable cost estimate. Of course, you cannot capitalize if you can't reliably estimate the development cost, right? Then availability of resources. Technical feasibility. whether technically feasible, economically feasible, meaning financially feasible. So technically feasible, financially feasible. So if I may recap, probable future economic benefits, intention to complete and sell, available ability to sell, reliable cost estimation, availability of resources, technically feasible and economically feasible. If you fulfill all these criteria, then development cost can be capitalized. Why I'm stressing this? Under this standard, this is the most important area, right? So the rest of the things are very much straightforward. So when it's come to measurement, it is recommended you measured only at cost, while revaluation model has been given in the standard. But you know, intangible asset revaluation won't go well, right? Unless you have an active market for that intangible asset, then you can go and do the revaluation. So most of the cases, it is always convenient and correct and appropriate to measure at cost. Of course, afterwards you should decide your amortization period and amortize. However, by nature, intangible assets have three types. Intangible assets are three types. First, intangible with indefinite useful life, intangible with definite useful life, intangible which are in the process to be used, meaning intangible assets which are not ready to use. Like let's say for example, development cost you can't capitalize this year, maybe next year. So it's a kind of an intangible asset, but in the process of completing, right? Not completed yet, not ready to use, right? So other intangible asset, it could be indefinite useful life intangible like goodwill. Goodwill, you don't have a definite useful life, it's indefinite. And there are certain intangible assets with definite useful life. So intangible assets with definite useful life, you do the amortization, and when indicators exit only, you do the impairment for intangible assets with definite useful life. But intangible assets with indefinite useful life and intangible assets which are not ready to use yet, you should do annual mandatory impairment. Annual mandatory impairment meaning regardless what would be the outcome, you should do the impairment assessment, right? For intangible assets with indefinite useful life and intangible assets which are not ready to use, right? So that is LKS 38. With that, let's move into LKS 40, that is investment property. So what is investment property? Now we have discussed about PP&E, property, plant and equipment, and we have discussed about intangible assets. The main difference between property, plant and equipment and intangible assets are property, plant and equipment have a physical substance, but intangible does not have a physical substance. So what about investment properties? Does it have a physical substance? It does have a physical substance? Yes. So LKS 40, investment properties. So LKS 40 is for investment properties. So investment properties are basically properties. Because it say investment properties, it is mainly referred, or it is most of the case, so maybe 100% it is all about land and building, right? So investment properties are land and building which your intention is you keep for capital appreciation or rent to others. Rent to others. Of course, capital appreciation only relevant for land, rent for others, land and building, both, right? So you have a land and that is with no use, like a vacant land. And if your intention is to keep that land just to appreciate the value, and after some time you dispose it, that is your plan, then it's an investment property. And if you have a land or building which you have rented out to some other parties which you are not using, but some other parties are using, then it's a renting out. So that is also an investment property, right? So it's kind of straightforward, but there are certain practical application challenges also. So let's look at what are the main areas which need to be discussed under this standard. Right. So let me take the lineup for easy purpose. We have discussed the definition, then initial recognition, subsequent measurement, of course, then transfers. So those are the, and mixed use. Let me use that way, easy to discuss. So we discussed the definition. So it's land and building, either capital appreciation or renting out to others. Initial recognition, it should be always at cost, and like PP&E, cost mean purchase price, directly attributable cost. If any dismantling, decommissioning apply, you can apply that. Like same like PP&E, but the definition, the purpose change. By the way, now I said intention. So if my intention is to use for myself, my business, then it's PP&E. If my intention is to rent out to someone or keep it for capital appreciation, then it's investment property. Whose intention then? Is it the intention of the finance manager? Is it the intention of the accountant? No, the intention of the management. So basically the board of directors. In a company, board of directors must tell what is their plan for this particular land or building. If their plan is clear that it is kind of capital appreciation or renting out others, renting out is straightforward, you can see it. But maybe now you have a vacant land, right? Question comes in, how I should account for it? Because we never know that the directors have taken this land to build up a factory there, right? So then you have to go and ask from the directors. Directors might say, okay, look here, we just got the land. Let's we have a plan down the line, but it won't take that soon. So it may be some after 5 years kind of. So why not we rent out this property to different people for different purpose? So let's keep it there. Put some securities and whatever. Let's keep it there. So then the intention is clear, capital appreciation. Until such time intention get changed, you can consider as investment property. Okay. So initial recognition cost and subsequent measurement. Interesting. Yes, under PP&E, subsequent measurement was cost or revaluation. Here, cost of at fair value. So some misunderstood this thing. They also sometimes they used to say investment property also cost or revaluation. That is wrong. So revaluation for properties discussed only under LKS 16 property plant and equipment, LKS 38 intangible assets also, that is applied but not in practice. But when it's come to investment property, even though those are land and building, those are investments. So when you say investments, the fair value concepts coming in. So subsequent measurement, you can keep it at cost or fair value model. If you do continue at cost, this is like PP&E, meaning it is cost minus accumulated depreciation minus impairment, because it's like PP&E if you continue at cost. But if you go with fair value model, changes in fair value should be recognized in P&L, either gain or loss. If the fair value increase, that's a gain. If the fair value come down, that's a loss. But that should be in the P&L as a separate line item. Fair value gain or loss on investment properties. That is a separate gain or loss. It's part and partial of P&L, not OCI, right? Question comes in. How frequent we need to assess the fair value? Now you remember PP&E, if you go for revaluation model, you should do every 5 years as a practice, but of course in between you can do if the circumstance getting changed. But when it's come to investment property, it is mandatory the fair value assessment should be taken place annual basis. Meaning if you have done this year, next year also you should do the fair value assessment, and any changes in the fair value you can record in the P&L. Fair value every year, but using an independent valuer for the fair value assessment, not necessarily every year, every 3 years. As per the standard, at least every 3 years, you should get an independent valuer to do the valuation of investment property. But every other fair value assessment can be done by someone else who has the relevant competencies and qualifications. So indirectly pushing, okay, you should go every year independent valuer. That's the indirect thinking. But if someone has the capability and the capacity and the skills and qualification to do the annual fair value assessment, rather go to independent valuer, yes, you can do it, unless you should go for an independent valuer, right? So that's a fair value thing. What about transfers? Transfers means, now I said, let's take a look at that land, right? Let's take a look at that land. Let's take a look at that land, and that land was initially for capital depreciation, and this year you have recorded as investment property there. But next year come, intention has been changed. The directors have decided, okay, let's start building up a factory there for the company's purpose. So now it's not investment property, it's a property, plant and equipment, because part of the business. Now you can't consider as IP, it should be PP&E, but it's sitting under IP. So it should get transferred from IP to PP&E. So what's the standard says? When there is a transfer from investment property to PP&E, first do the fair value, and the fair value gain or loss you can charge to P&L, like what you have done for investment property. And this fair value should be taken to PP&E, and under PP&E you can go at either revaluation model or the cost model, right? Revaluation or the cost model. That is IP to PP&E. What about PP to IP? Now you had a land you are using, you had a building you are using for your factory. Now you have discontinued that operation. Now you want to renovate and rent it out to different parties, that building. So no longer PP&E. It is not PP&E in that case. It is IP. It's an IP. So here what you should do is, as per the standard, you should do a fair value assessment under PP&E. And the changes need to be, if the building value goes up, changes should be recorded as revaluation surplus under PP&E, and the fair value should be transferred to IP, and under IP you can continue under cost model or fair value model. So that is a transfer, right? That's one of the interesting area that you should know when you apply the standard. What about mixed used? What about mixed used? What do you mean by mixed used? Let's say you have a building, 5-story building. Two floors are used by you, the company, and 3 floors are used by others. This is company's building, 5-story building, and 2 stories are occupied by the company and 3 stories are rented out. Just because part of the property has been rented out, you can't take everything as investment property. You need to ask the question whether there is a significant element either goes as owner occupied or investment property. Significant element. In this case, out of 5 stories, 2 stories are used by the owner. So it's a significant element. So what you should do is these 2 story, two you should take as PP&E. These 3 floors you will take as IP. Suppose 5 story building, but owner is using only an insignificant portion. Let's say 5th floor, 2 rooms, you are using 2 cabins, you are using for your business, and the rest of the facility has been rented out. So yes, owner is using, but it is insignificant. So in that case, standard say if it is insignificant, consider entire property as investment property, vice versa. Meaning you have a 5 story building, the other case you are using for your business, and someone else has also occupied a small area and he is paying some amount as rent, service fee or something. Just because someone else is using, you can't take it as investment property because it's insignificant. In that case, everything is PP&E. But if you're using an insignificant amount of area of the property which is belongs to you and the rest have been rented out, then everything you can consider as investment property because majority, substantially everything has been rented out. So that's in other area which is very much important under this standard. So with that, we are done with LK's 40. So before moving to impairment standards, let's look at the other category of assets that is discussed under SLFRS 5, right? That discussed under SLFRS 5. So SLFRS 5 is all about non-current assets held for sales and discontinued operations. Let me take an example. Let's say I'm running a business where I have a few segments in my business, manufacturing of consumer products, manufacturing of, let's say, shoes, manufacturing or transport services. Like I got few segments, but one business. So I have realized when I was analyzing the performance of each segments, each areas, I kind of felt like my transportation sector is not performing well. So why not I shut down that division? So when you shut down that division, you know there are certain assets belongs to that division will be taken out unless that can be used by some other division within the entity, right? So let's say there are certain specialized assets which are not required for other divisions. So there are certain assets, let's say furniture and fittings, even other divisions have sufficient furniture and fittings, so they don't need, so you may have to take it out. And from the other side, because you are disposing or taking out, shutting down your transportation division, so whatever uh, profit and loss will not be continued from those operations. So those operations related profit or loss need to be separately disclosed, because otherwise users will get a different idea, because they feel like everything you present in a normal structure of P&L, it's all continuing business. But if you're discontinuing any of your department, the profit or loss relevant to that department need to be presented in the face of income statement as a separate line item, including the comparatives. So that's one thing. And because you discontinue your department, and because certain asset then will be removed and certain liabilities may be, so those assets sitting as PP&E is wrong, sitting as inventory is wrong. So you need to separately show them in the statement of financial statement position we call as non-current assets held for sale, right? So that is the idea of bringing this standard. So basically, yes, the standard apply when you have a discontinuation situation or discontinuation of operations, or like you have a certain asset that you are planning to dispose. Not necessarily you have an operation discontinuation, but there are certain assets you are going to sell, not this financial year, but maybe next financial year. So what standard says, basically when it's come to the standard, so non-current assets held for sale. So for you to classify or present any asset or class of asset as non-current assets held for sale, the proposed disposal should be taken place within next 12 months period, and there should be some active actions for the proposed disposal. There must be a kind of identified buyer or like a process of selection of buyers, and there must be a kind of an understanding about the price, right? You don't have a price, meaning you can't measure it reliably, you can't record. Like cost can be measured reliably, same thing apply. Fair value should be established fair reliably, right? So then only you will basically go for this classification, meaning if it is 31st March 2025, if the board is now discussing at the year end before 31st March 2025, very important, before 31st March 2025, this event should take place, this decision should be taken before the year end to make it non-current assets held for sale for your financial year. If it is taken after the financial year end, then that will not have an impact for your financial reporting. So directors have make a decision, okay, we are going to dispose it. Let's do the whatever advertising and whatnot, and let's do the buyer selection, and also coming up with a kind of a pricing, understanding what should be the price and all. So if all these things are happening actively, and you have intention, to complete the disposal within next 12 months, then it's non-current assets held for sale. So let's say now you got the asset, recognition is okay, within the recognition criteria are satisfied. Then what amount? Standards say the amount should be lower of carrying value. Carrying value means what is in the book at the moment, or the fair value. So you should do a fair value assessment of the asset which you are going to dispose, meaning fair value means the price that you are expecting to receive, consideration that you are expecting to receive. Compare that with carrying value. If there is a gain, continue recognizing at carrying value if there's a gain. If there is a loss, meaning fair value has come down compared to carrying value, recorded this amount, and the difference you should recognize as impairment. You can't say loss on disposal because disposal is yet to be taken place, but you know that when you dispose next year, you are getting lesser amount compared to the carrying amount. So today you should create an impairment loss in the books of financial statement if carrying amount is higher than the fair value. If the carrying amount is lower than the fair value, meaning other way, fair value is higher than the carrying amount, then you can continue recording at carrying amount and no gain, no loss adjustments, right? So that's the requirement. So when it comes to discontinued operation, I told you discontinued operation should be separately present in the statement of comprehensive income before profit before tax. So what you do is profit loss, of course, is a loss because that's why you discontinue. Loss on discontinued operation in your P&L, you will have a line item and you will give a note number X, and note X you will have revenue, you will have cost of sales and everything like a P&L, and you will have the amount. So in the notes you will give the detailed P&L for the division, discontinued division, but when it comes to face of income statement, you will only get the net result and show as a one line item. When the reader, then the reader knows everything else will continue, only this department has been discontinued. That's the meaning, right? So that is mainly SLFRS 5. So let's get into our last segment for this session, that is LKS 36. That is LKS 36. Okay, LKS 36 is about impairment, but don't confuse yourself. Here under LKS 36 mainly we are discussing about non-current non-monetary assets. Non-current non-monetary assets. Why non-current non-monetary assets? If I may explain. Now impairment anyway come for assets, right? Assets. So assets, you have, let's say, financial assets, non-financial assets. Okay, financial assets, you have current, you have non-current, right? Likewise, non-financial assets, you have non-current, you have current. Okay, financial assets, regardless current or non-current, you have SLFRS 9 to discuss about impairment of financial assets. So this part is not coming under LKS 36, right? This is not coming. Non-current, non-monetary financial, non-monetary assets, current, let's say you have inventory, prepayments and whatnot. So mainly inventories. So inventories and other assets. So inventories and other assets, you will have LKS 2 to discuss about the impairment, right? So in non-current assets, you will have PP&E, intangible, IP, and let's say investments. So investment again, if it is non-financials, yes, LKS 36 apply, right? But if it is like investment in subsidiary, LKS 36 apply. PP&E, IP and investment property anyway, because you are doing fair value, if you are following fair value, it won't apply. But if you follow cost model, again LKS 36 apply. PP&E and intangible, LKS 36 apply in this case. That's why I said non-current, non-monetary assets only comes under LKS 36. The rest you have separate standards, right? So why I have given this thing, like under LKS 36, when you do impairment assessment, let's say you got an impairment loss for a cash generating unit with goodwill, right? Now you have a question how to allocate this impairment loss, and you may remember impairment loss should be allocated first to the goodwill and then the rest should be proportionately. But when you say proportionately, you will only need to look at non-current, non-monetary asset for proportionate allocation of impairment losses, because other assets categories are dealt when it comes to impairment in a separate standard. Okay. Firstly, we know impairment means if the value goes down, recognize that reduction in value as impairment loss. That is to discuss that impairment standards coming in, right? So core principle. So core principle in impairment is you compare your cost with recoverable amount, right? You compare, and if cost is higher than recoverable amount, the difference is your impairment. If the cost is higher than recoverable amount, the difference is impairment. So what is recoverable amount then? Recoverable amount is higher of value in use or fair value less cost to sell, right? Let's say fair value or value in use, whatever higher is your recoverable amount, compare with the cost. If the cost is higher than recoverable amount, the remaining should be recognized as impairment loss. So that's the core principle, right? That's the core principle. But first question to ask, okay, core principle should be applied to determine what is the impairment or whether there is an impairment. Before that, you need to ask the first question, should I need to do impairment assessment? Right? You do impairment assessment and you recognize loss, then you record. If you don't recognize loss, you don't need to record. But first place, do I need to do an impairment assessment? That's the first question, right? When? Right? This is how it is. Definite right, assets with definite useful life when indicators exist. So you do impairment assessment. Before you do impairment assessment, ask the question whether it's an asset with indefinite useful life. Whether I'm talking about an asset, non-monetary, non-financial, non-monetary, non-current assets with a definite useful life, yes, I should do impairment assessment only if there are any impairment indicators. Or asset with indefinite useful life, here we normally take intangibles like goodwill, trademarks and whatnot. Here it is mandatory at the end of each year that you should do an impairment assessment regardless of the indicators present or not, regardless of the outcome. If it is an asset with indefinite useful life, impairment assessment at the year end is mandatory. Is mandatory. Third category, if there are any intangibles, we discussed this before, which are not ready to use. If you have any intangible which are not ready to use, same thing apply. At the year end, as a mandatory requirement, you should do the impairment assessment. So you can understand if it's an intangible asset with indefinite useful life, or if it's an intangible asset which is not ready to use, you should do a mandatory year-end impairment assessment regardless of indicators. But if it is an asset with definite useful life, you will do the impairment assessment only when there are indicators. So this is clear. You should do, and you should always apply core principle every year. But you to apply core principle for asset with definite useful life, first you need to ask whether this is present. So let's look at what is it, right? So if it is an asset with definite useful life, first need to have impairment indicators. So what are impairment indicators? So impairment indicators are two types. Internal and external. So impairment indicators, you have two types of indicators, internal indicators and external indicators. Internal indicators, wear and tear of assets, losses, continued losses from the business, or like slow moving or like slow productions, idle assets, those are the internal indicators. External indicators, negative economic outlook, political uncertainties or political unrest, technological development. Because of technological development, your existing technology has been sort of gone out, expired. So those are external factors. So you ask for your assets with definite useful life, whether there are any indicators as such, either internal or external. If the answer is yes, then you know the core principle. You should establish, if the answer is yes, you should establish the recoverable amount. So recoverable amount is higher of value in use, so fair value less cost to sell. Now, see, if you can go with if you ask me like what is the most easiest way, ideally if the asset has a fair value, asset has a market, or the market there's a value readily available, the fair value exercise would be easy. However, like most of the time in practice, the entities like to go for value in use calculation rather fair value, because they don't have a plan to sell it. If you don't have a plan to sell it, applying fair value again maybe not meaningful. So first what you do is, either way, I mean standards say that you can apply both and you should get the higher of it, right? Higher of these two. So let's say you first go to the market and you establish fair value, and that is reasonable, and that fair value is more than the carrying amount, then matter is closed. If the fair value is more than carrying amount, even though there are indicators, no impairment. But let's say now you have done the fair value assessment and fair value is lesser than the carrying amount. Then there is a triggering point that there is an impairment. But you don't go and do impairment provision, because you were asked, okay, higher of fair value or value in use. So if this is fair, you can still try this one. So value in use mean what is the total amount of cash you are getting by continuing using of this asset. So meaning you have to establish future cash flows which you are going to generate through this asset, present value it, and take that amount that is value in use and compare that amount with the carrying amount. If now this is out, if value in use is higher than carrying amount, then no problem, because you were asked to use the higher of value in use of fair value, no impairment. But if both goes in the same direction, then use the higher of these two, and with that compare the carrying amount and recognize impairment loss. So that's the basic idea of impairment standards. However, there's another interesting area in this standard that you should understand, that is cash generating units. So certain entities, like they have different segments, different units which generate cash flows. Now let's look at same example now, machinery, right? Let's say now you have some impairment indicators about a particular machine, and that will ask you to do the impairment assessment. So now how you decide if you go for, let's say, assessing the recoverable amount. Now you have to assess how much you are getting out of this. Let's say, for example, in value in use case exercise, you can't just look at the machine and say, okay, these are the cash flows I am getting out of this machine, if this machine is part and parcel of your entire business. So your entire business generating cash flows, machine is a critical component of that, but machine itself will not generate future cash flows. It's the entire entity will generate cash flows. So in that case, applying value in use concept for machine will not be practical, because there's no independent cash flows coming out from the machine. So that's why this cash generating unit concept has been comes out. So what it says, cash generating unit is the smallest unit of assets which can independently generate cash. So you need to, when you do impairment assessment in your entity, you need to ask the question, looking at the underlying assets, am I looking at entire entity as a cash generating unit, or can I separately identify cash generating unit within the entity and identify which cash generating unit these assets are belongs to? which are subject to impairment, right? So for that, you need to ask the question, what is the smallest component of group of assets which generate independent cash flows in my entity? Is it a kind of a department, or is it the entire entity? If it is entire entity, that is your cash generating unit. Your company is your cash generating unit. But if you can identify separate cash generating, separate class of asset, group of assets which can generate independent cash flows compared to the other unit, then those are different cash generating units. So that unit you can do the impairment assessment. I mean, look at assets subject to question CGU1, CGU2, CGU3. Okay. Asset subject to question, is it under here? No. If it's under here, yes, it's under here. Okay. This is what you need to do the impairment assessment. Not the entire company, but for this cash generating unit. So there, you assess your future cash flows or the present value or the value in use for this cash generating unit or the fair value of this cash generating unit, get the higher as the recoverable amount, compare with the carrying amount of this cash generating unit, and then come up with the impairment loss. Now the question comes in, okay, I got an impairment loss for the cash generating unit, but how I'm going to do the adjustments? Cash generating unit means many things. Okay, asset wise, asset 1, asset 2, asset 3, asset 4, asset 5. Let's say machineries, computers, debtors, inventories, and some other assets. Okay, this cash generating unit has an impairment loss of, let's say, 100. Okay, but I have few assets coming under this cash generating units. Where I am going to deduct this 100? Is it deduct from the machineries because that's the one of the most critical assets? No, that's wrong. So standard says, when you have a scenario of cash generating unit and you found an impairment loss for the cash generating unit, which you need to do the accounting, then it says to apply this way. Okay, now you have a cash generating unit and you have an impairment loss. Ask the first question. First question. Any assets with indefinite useful life? Answer would be yes or no, right? Yes, first apply to this one. Apply loss to this one, right? And if any remaining, proportionately. Proportionately, right? If you have impairment loss for the cash generating unit, first ask the question whether there are any indefinite useful life assets in the cash generating unit. If that is the case, you apply your impairment loss first against that asset with indefinite useful life. If any remaining, meaning after maybe 100% impairment, because remaining means 100% impaired, right? Remaining, you apply proportionate basis for the rest of the assets should come under this standard scope. If no asset with indefinite useful life, then it's proportionately. So in this, while by doing this, if your impairment loss is lower than the carrying amount of the asset with indefinite useful life, your full allocation for that asset only, because it's lower than, and that asset also will have a amount remaining. No proportionate allocation because no impairment loss remaining because you apply. But if impairment loss is higher than the carrying amount of the indefinite useful life asset, then 100% impairment of that assets, and the rest of the amount loss you proportionately apply for the rest of the assets. And interestingly, let's say subsequent year your cash generating units value news, so the recoverable amount has been improved, so there's a possible reversal of impairment loss. There's a reversal of impairment loss. Yes, you can reverse impairment against the assets which you have done the impairment proportionately, but you can't bring back that asset with indefinite useful life. Once you have done 100% write-off, that is done and that won't come back. So you need to understand that also, right? Meaning, If you have done 100% impairment for an indefinite useful life intangible asset, it will not come back to your books of accounts, right? Okay, so with that, we like to conclude our second session on the giving some awareness about the key accounting standards. In this particular segment, we discuss about few standards which are connected to the assets of the statement of financial position. And the next session, we are going to discuss few other important standards.